Welcome back to the Daily Crypto Roundup. Today's episode is about balance, tension, and a market that still refuses to make its mind up. Over the last 24 hours, we've seen sharp moves lower, forced liquidations, negative headlines, and plenty of caution creeping back into sentiment. But at the same time, we've also seen buyers quietly stepping back in, prices lifting off the lows, institutions continuing to position, and analysts refusing to call this either a breakdown or a breakout. That's what we're going to unpack today. What pushed the market down, what's supporting it now, and why this still feels like a market in transition rather than a market in trouble. Before we get into the news, a quick word on the XRP giveaway. We're running another one this week. One comment on this episode will receive 10 XRP, and another comment will receive 5 XRP. Winners will be announced on Friday, and we'll reply directly to the winning comments so you can leave the wallet address you want the XRP sent to. Comments have been a little lighter than usual this week, so if you start commenting now, your chances are actually better than normal. Make sure you're subscribed, drop a comment, and stay involved. Before we get into the headlines, here's where the market is trading right now. Bitcoin is at $87,703. Ethereum is at $2,946. Binance Coin is at $869.08. XRP is at $1.92. Solana is at $127.18. Dogecoin is hovering around 13 cents. Cardano is holding 38 cents. Litecoin is at $78.90. Avalanche is at $12.17. And Polkadot $1.89. So the big picture is still the same. The majors are steadying, but most of the market is still trading with a cautious tone and tight risk management. Now let's get into what's been driving this. The first major theme today has been liquidation-driven selling. Bitcoin and Ethereum both moved lower as leveraged positions were forced out of the market, wiping out hundreds of millions of dollars in a relatively short window. On the surface, this kind of move looks aggressive and alarming. But analysts have been quick to stress that forced liquidations are mechanical events. When leverage builds up, a move in one direction can cascade quickly, regardless of broader conviction. Once that leverage is flushed out, selling pressure often fades just as fast. And that's where the second part of the story comes in. While short-term traders were being forced out, longer-term investors appear to have been stepping in. Multiple reports today highlighted continued accumulation by long-term holders, even as price dipped. This is important because it suggests that beneath the volatility, there's still underlying demand. The market isn't seeing widespread abandonment. It's seeing a transfer of coins from weaker hands to stronger ones. Cathie Wood has also weighed in on this latest bout of volatility, and her stance remains firmly bullish on Bitcoin despite the near-term turbulence. Through ARK Invest, Wood has continued to add exposure to crypto-linked assets during the pullback, arguing that periods of stress and forced selling often present long-term opportunities rather than warning signs. She's reiterated that Bitcoin's core thesis hasn't changed, pointing to growing institutional adoption, increasing regulatory clarity in major markets, and Bitcoin's fixed supply as key drivers over the long term. While she acknowledges that macro conditions can dominate price action in the short run, Wood's view is that these moments of uncertainty are often when longer-term positioning quietly takes place, setting the stage for future upside once sentiment stabilizes. Now we are going to take a short break here for a word from our sponsors. Stay with us. In our next story, Ethereum has also been under pressure, with price slipping below the $3,000 level as US Ethereum ETFs recorded multiple days of net outflows. On the surface, that paints a bearish picture. Weaker price action combined with capital leaving regulated products. But, as always, the full picture is more nuanced. Analysts point out that ETF outflows don't necessarily mean long-term rejection of Ethereum. In many cases, they reflect short-term positioning, profit-taking, or rotation, rather than a loss of conviction. Ethereum has underperformed Bitcoin in recent weeks, and some investors appear to be reallocating capital rather than exiting crypto altogether. There's also the broader macro backdrop to consider. As risk appetite fluctuates, assets perceived as higher beta often feel pressure first. Ethereum, sitting between Bitcoin and the wider altcoin market, tends to absorb that tension. Add in uncertainty around interest rates and liquidity conditions, and ETF flows can quickly turn negative without signaling structural weakness. At the same time, analysts note that Ethereum's fundamentals haven't materially changed. Network usage remains strong, staking continues, and long-term development around scalability and tokenization is ongoing. The disconnect between price, flows, and fundamentals is something we've seen before, particularly during transition phases in the market. In that sense, Ethereum's current position mirrors the wider crypto market, caught between caution and conviction, with short-term flows telling one story and longer-term development telling another. We are going to take a quick break here for a quick word from our sponsors. Stay with us. Okay, welcome back. We were just talking about Ethereum, now let's move on to XRP. Price action has been soft, with XRP dipping below key support levels and spending time under $2. On its own, that looks negative. But at the same time, XRP spot ETFs have now recorded nearly a month of consecutive inflows, approaching $1 billion in total. So while price has been under pressure, capital has continued to move into regulated XRP products. Analysts see this as a classic example of price and positioning diverging in the short term, often a sign of uncertainty rather than conviction in either direction. Institutional infrastructure has also continued to expand quietly. CME Group announced the launch of spot-quoted futures for XRP and Solana, giving institutions more tools to hedge and trade exposure to these assets. These kinds of developments rarely move price immediately, but analysts stress they matter structurally. Futures markets deepen liquidity, attract professional participation, and often lay the groundwork for future capital flows. The fact that this expansion is happening during a period of price weakness reinforces the idea that infrastructure is being built regardless of sentiment. And that's where the second part of the story comes in. While short-term traders were being forced out, longer-term investors appear to have been stepping in. Multiple reports today highlighted continued accumulation by long-term holders, even as price dipped. This is important because it suggests that beneath the volatility, there's still underlying demand. The market isn't seeing widespread abandonment. It's seeing a transfer of coins from weaker hands to stronger ones. Another story that flew slightly under the radar today but carries broader implications involves stablecoins. An independent audit has verified that the gold reserves backing Kyrgyzstan's USD-KG stablecoin fully match the tokens in circulation. On the surface, this might sound niche, but analysts say it speaks directly to one of the most important debates in crypto right now: trust and transparency. Stablecoins sit at the heart of the crypto ecosystem. They are the bridge between traditional finance and digital assets, used for trading, settlement, payments, and increasingly real-world commerce. Because of that, scrutiny around reserves and backing has intensified. Any example of third-party verification is seen as a step toward maturity, particularly for asset-backed or commodity-pegged digital currencies. Analysts also note growing interest in alternatives to purely fiat-backed stablecoins. Gold-backed tokens in particular appeal to regions and investors looking for a hedge against currency risk, while still benefiting from blockchain efficiency. While these products remain small compared to giants like Tether or USDC, they highlight how diverse the stablecoin landscape is becoming. This ties into a bigger regulatory narrative as well. As governments move toward tighter oversight, transparent reserve structures and independent audits are likely to become non-negotiable. So while this story doesn't move markets today, it reinforces the direction the ecosystem is being pushed in: less opacity, more verification, and closer alignment with traditional financial standards. Stepping back, the overarching theme today is indecision. This doesn't look like the start of a major breakdown, but it also doesn't look like a market ready to surge higher without hesitation. Weakness is being met with buying. Bad news is being offset by structural progress. Analysts are divided, and conviction is low. Historically, these kinds of conditions often precede volatility rather than resolve it. That's why the recent bounce matters, even if it doesn't answer the bigger question. It shows there is still demand. It shows the market is responsive. And it shows that despite all the caution, crypto remains very much alive. And before we wrap up today, it's worth saying this out loud. This phase is frustrating, It tests patience, confidence, and conviction. And that's true for everyone, including us. When markets chop, headlines contradict each other, and price action refuses to give clarity, it's easy to feel drained or second-guess every decision. But these are the moments that separate participation from conviction. This is where understanding is built, where noise is filtered out, and where long-term positioning quietly happens while attention fades. You don't need to have all the answers right now. You just need perspective, discipline, and the willingness to stay engaged when it's uncomfortable. Markets don't reward comfort, they reward patience. And if you can stay steady through this, you're already doing better than most. Stay safe out there, stay vigilant, and as always, we will see you at the top.